In this lesson, I want to share with you a bit of the Forex history. Now, you don't really need to know the history of Forex. It's just I thought, it would be good to know. So, of how basically Forex trading evolved. Now, this is sort of a little short version of, history of Forex. So you started with it's actually it's first the barter system, and then it became the first gold coin, and then gold standard. Then, major current countries started joining it, as well as the Americans, all of that kind of stuff. You can pause it, to read it. Um, but we'll go into more detail with those soon. So the first thing I want to share is that trading isn't how it was, in the olden days. So in today's trading, you just have to click the buy or sell button, and your broker or your brokerage firm would now execute your trade electronically. Okay, and this happens not even in a matter of a second. Okay, but it wasn't like this, before 1996. So before 1996, in the olden days, the olden days of trading, um, what would happen is, I'm sure you've watched movies such as Wolf of Wall Street, Billionaires Boys Club, movies like that. Now, for an example, I'm going to go with the Wolf of Wall Street. So, as you know, Jordan Belfort, who plays, Leonardo DiCaprio plays as Jordan Belfort in that movie. You would see, him and his team would, be on the phone a lot of the times. They are the brokers. So it's basically, okay, they more into stocks in that movie. Okay, we more into currencies. So, but it's the same concept basically. So, a trader would phone you as a broker and tell you, hey, Mr. Broker, I want to place a trade on Euro USD at this price. If it reaches this price in profit, please take it out. If it reaches this, this price in loss, please, take it out. And then the broker would do it. Okay, not like today where it's just, electronically. However, so retail traders, we are retail traders, us as individual traders. Now, brokers introduced the platform to us, and they introduced lot sizes like a standard lot size and a mini lot size. Now, your standard lot size is 100,000 units of the base currency, and then your mini lot size is 10,000 units. We'll get into lot sizes a bit later. So as time evolved, as more people were entering the trading world, so traders became bigger and bigger. So brokers offered an even better sort of lot size. Okay, micro lots, that's 1,000 units, because as traders came about, not many retail traders have a lot of capital to place big trades in the market. So this is how the brokers then came up with micro lot sizes, giving the little guy also a chance to make money in the market. Now in today's world, you get also nano lot sizes. Not many people know this, but it's 100 units of the base currency. It's not very popular, as it is too small, to really profit from it. It's more for like beginners, just to test the waters of the market. So all of this, with all these types of lot sizes, this allows, us retail traders, we don't need a lot of capital to trade. When like back then, you need like $10,000 to place a trade, for example. So not in today's world. So as well as those lot sizes, brokers also offer, leverage and margin. We'll also get into these two in more detail a bit later on. But like your leverage, for example, it would range like from 1 to 50 and up to 1 to 3,000. It just depends on your broker that you choose. Okay, which country it's from, like, the regulations and all of that kind of stuff. That it depends on those type of things. It's just, what this means is it's allowing individual traders to make larger trades, okay, based off of the amount of margin they have or the amount of money they've deposited. So I'm going to give you this example quickly. A 1 to 100 leverage, okay, with a $2,000 margin deposit would enable you to control positions as large as 200,000. So if you had $2,000, okay, with a leverage of 1 to 100, you can control trades that are $200,000. Okay, it might not make sense right now, but like I said, we're going to go into leverage and margin into greater detail later on, but that's just the basic. Now, retail trader brokers offer leverage to allow individual traders to trade in large amounts relative to small size of pips. Okay, don't worry, we'll get into that. So, for the first one, the barter system. This is basically where the foreign exchange basically originated from. It's how it began, and like I said, it is the oldest sort of method of exchange. Began in 6000 BC. Now, it was introduced by the Mesopotamia tribes. Under the barter system, goods were exchanged for other goods before money was even thought of, before money was invented. Okay, now what type of goods? There were main goods, like you get main currencies like the United States dollar. So your main goods were like salts and other spices, right? They were the ones that became popular. The popular medium of exchange was salt and spices. So olden days there weren't cars and such things like that, so ships would have to sail to now barter for these goods in what we call the first ever form of foreign exchange, which is the barter system, right? Second up after that, as people evolved and everything evolved, the first gold coin came about, right? And this was made in Lydia. All right, so this was during the 6th century BC. Like I said, in Lydia. Now, this acted as a currency because of its characteristics. So it had a few good characteristics like portability, durability, divisibility, uniformity, limited supply, and acceptability. Okay, so this became now the great medium of exchange. All right, so yes, even though the first gold coin, it wasn't really pure gold. Okay, it was made up of a natural alloy of gold and silver, and this sort of natural alloy was then found in the rivers of Lydia. And yeah, so for the character, the physical characteristic of the gold coin, it was then stamped with sort of animal heads, such as bulls, lions, all of that kind of animals. However, it didn't last because it was impractical. It was too heavy, to transport or to carry around, etc. So eventually it didn't work out. Now, the gold standard was first adopted by England in the year 1821. Now, this guaranteed that the government would redeem any amount of paper money for its value in gold. And the classical gold standard existed from 1870s to the outbreak of the First World War, which happened in 1914. So it was quite a long time that this gold standard existed. So this is where European countries had to suspend the gold standard to print more money to pay for the war. So this is how basically the gold standard also ended, is because of the payments for the war. The foreign exchange market was backed up by the gold standard at the point during the early 1900s. And then countries traded with each other because they could convert now their country's currencies, okay, and then received it into gold. Like I said, gold standard couldn't hold up because of the wars, and surely after then it ended. However, I just want to explain, when America moved to gold standard and other countries joined, etc. So, like I said, England was the first, and then, America then joined the gold standard in the year 1873. This is when, the Congress finally then followed England and all those other, major nations. So, by holding national currencies stable against gold, the international embrace of the gold standard encouraged foreign investments and facilitated trade, giving rise to the first era of intense globalization. And then after all those countries, after America and everything, all other major countries then, joined. So it was first England, then major currencies, and then it was America, and then the rest of, other countries. So once, the gold standard ended, because, like I said, of the war, something called Britainwood system was then sort of, invented. This was the first major transformation for the foreign exchange market. And this happened at the end of World War II, from 1944 to 1971. So also a good couple of, few years. This was to create a stable environment by which global economies could restore themselves, especially, after the war did a lot of damage, so they needed to restore themselves. So this sort of Bretton Woods agreement, failed to peg gold to the USD because there was not enough gold to back the amount of US dollars in circulation, because it had to increase, so that the American dollar increased because of government lending and spending after the war. So President Nixon ended Bretton Woods system in the year 1971, which then obviously led to something called the free floating of the US dollar against other foreign currencies. Now, free floating system obviously came up next. Like I said, it was after the Bretton Woods system, okay, or after Bretton Woods Accord, whatever you want to call it, is the Smithsonian agreement, which happened in 1971, in December. It was similar, okay, but greater fluctuation ban for currencies. The monetary system in which exchange rates are allowed to move due to market forces without intervention by the country's governments. So then, America pegged their dollar to gold at $38 per ounce. That was crazy cheap. Okay, obviously not back then, but if we look at it now, it's a couple of $1,000s right now. Thereby, it was depreciating the USD. So under this agreement, then other major currencies could now fluctuate by 2.25% against the United States dollar. In the year 1972, the European community tried to move away from its dependency on the US dollar, okay, and then, was established by West Germany, France, all these sort of European countries. So both agreements made mistakes, like the Bretton Woods Accord, and in 1973 it collapsed. So another sort of foreign exchange system collapsed. These failures resulted in an official switch to the free floating system. Right. So after the free floating system became the Plaza Accord. So this happened in the early 1980s, when the dollar appreciated greatly against other major currencies. So this was hard for exporters, especially those, factories that, those American factories in other countries, because they had to compete with foreign competitors. So in the year 1985, some group called the G5, okay, this is where the most powerful economies in the world come together. It includes America, UK, France, Germany, and Japan. So this sort of G5 group sent representatives, okay, to what was supposed to be a secret meeting, okay, at, the Plaza Hotel in New York City in America. However, this sort of secret meeting got leaked somehow, okay, and the group had to now make a statement encouraging the appreciation of non-dollar currencies. So this was the Plaza Accord. So it didn't take long for traders to realize the potential profit in the new world of currency trading, because remember, now there was fluctuation in the market. And as a trader, where there is fluctuation, there is profits to be made. And so after a decade, it became clear after the collapse of Bretton Woods system. So, excuse me if I don't pronounce this correctly, the Maastricht Treaty sign, okay, came about. This is where the European Union was then, came into effect. It was signed in 1992 and got effect in 1993, right? So it's a group of 27 countries that operates as a cohesive economic and political bloc. Okay, now not all 27 countries use the euro. I think it's like 19. Yeah, 19 of the countries use the euro as their official currency. So in 1998, the year I was born, the ECB, the European Central Bank, was then created. At the end of the year, conversion rates between member states' currencies were fixed, a prelude to the creation of the euro currency, which began circulation in 2002. So the euro was now, it began circulating in only 2002, not so long ago. What, 20 years? Right. After that became internet trading in the 2000s. So in the late 1990s, the currency market grew more sophisticated and faster than ever because of money and how people viewed it and used it. Now, this is where a person at home could, like I said, click a button and you could get the accurate price, whereas a few years ago you had to call your broker, telephone call, blah, 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 right? Everything changed. Currencies that previously shut off in political systems could trade, right? So the world was opening. Emerging markets such as in Southeast Asia flourished, attracting capital and currency speculations. Competitive forces creating a marketplace with unparalleled liquidity. Spreads have dropped big time, okay? So remember, the lower the spread, the better for you as a trader. So now, because of the spread that's dropped big time, there was online competition amongst trustworthy participants. So if there's a lot of brokers with lower spreads, there's high competition in the market. Individual trading large amounts now have access to the same electronic communication networks used by international banks and merchants. So we in the market of the big boys. And then, in today's trading world, it is the largest financial market, in the world. Like I said, $7.2 trillion daily turnover. Future of Forex is shrouded in uncertainty and is ever-changing, leading to everlasting opportunities for Forex traders. There is so much opportunity in the market. Currency trading can be very volatile, and the unique characteristics of Forex trading include leverage and a market that is open 24 hours, 5 days a week. Okay, all of these sort of pros or advantages, it attracts retail traders. It attracts the individual person like you and I to, trade on the market, because there is a lot of money to be made in this market. Digital cryptocurrencies such as Bitcoin have become very popular, in the recent years, and due to ongoing global uncertainty and seemingly unstable monetary systems, okay, it's unstable. As the years go by, it's getting more unstable, more unstable. These types of currencies, cryptocurrencies, etc., have a bright future ahead, since they represent an alternative to centralized and political controlled currency forms.